Hey, welcome back. This is Garrett with Gold Stock Analyst. Today we want to take a look at gold stock valuation. We've seen a lot of charts out there, similar to the one you're looking at now. Shows the HUI index relative to gold. It's a simple metric. It shows that the HUI was about 60% of gold back in 2002, whereas now it's fallen to about 13% of gold. So we look at this as a very simplistic measure. What we prefer to do is to look at our evaluation studies. This is from our GSA Pro report. We cover about 30 different gold producers. We calculate their average cash cost, which is $604 for all of the miners. And then what you can do is use the current gold price minus the cash cost gives you their operating cash flow margin. And then you can compare that to the HUI index, because stocks are a measure of future discounted free cash flow. So you can take a look at the operating cash flow margin as a basic measure to get you close to that free cash flow. And if you look at this, you can see that there's a really tight correlation between the HUI index in gold and the OCF margin in blue. OCF margin back in 2002 was about 45%. Right now, due to the price of gold increasing, the OCF margin is about 50, close to 50, I don't know, 55%. But you can see the really tight correlation right here. It's a 98% correlation, but that starts breaking down in 2015, where gold stocks really have not responded. The margins have creeped higher, but gold stocks have not kept pace. So as you can see here, there's a large gap between the HUI index and the operating cash flow margin. Now, you can do a simple regression. You take a look at the HUI index versus the predicted value that a regression would give you. And you see the tight correlation. You see the HUI getting above, fair valuation, and then, falling back below. But it's really, really tight. And then it kind of breaks in 2015, 2016. And now we've got the largest gap ever between your operating cash flow margin and the predicted value for the HUI index. So one more study is you can take a look at this, and you can look at this as a percentage. What's the percentage premium or discount versus based on the predicted value versus the HUI index based on this operating cash flow margin? And as you can see, the current versus predicted, went from fair value to overvalued, 40% overvalued, to 20% undervalued. And just it kept on rotating around this 0% fair value, which is, what is normal. However, since 2014, this ratio began to fall, and now the gold stocks are 49% undervalued. So bottom line, gold stocks are selling at a 55% discount versus their operating cash flow margin, which means that they basically, in order to reach fair value, they need to double here. So this is based off of straight multiples. It shows the sentiment in the market. When the market's doing well, multiples get stretched, and when there's investor apathy, multiples get compressed. So irregardless of the looking forward gold price, right now these miners are selling at a 55% discount, and they need to trade 100% higher in order to reach fair value.